I keep mentioning fundamentals, and I keep saying this is the reality of the company's operations. This is what they do. So what are these fundamentals? Well, the most fundamental of all fundamentals, it's that the company is selling something for revenues. So they provide a product or a service or something or a subscription that they sell for cash to their clients. This is what's called sales or revenues, or sometimes net revenues. This is the actual income to the company. So you sell cars, you sell a software subscription. You do that by first creating the product, which means that you have to buy a lot of stuff and you have to have people doing it, and you have to have systems for distributing the product to companies. So you have technology to create it, you have companies and tools to make it, you have various setups to make the product appear under the nose and eyes of the client and make them feel this urgency to actually buy your stuff rather than somebody else's. So this is what's creating the revenue stream. This is the lifeblood of a company. That is what they are there for. And if they are efficient and competent enough to do this the right way, then their costs of doing business will be in total less than their revenues. And this is what the difference creates, the profit margin. You can model this profit margin separately, or you can do it by modeling the actual cost items. But in any way, you have the sales item as the absolute fundamental of fundamentals, and then somehow they create a profit at the bottom line, and the profit, although not the lifeblood of the company itself, it's the lifeblood of you as an investor, because this is the surplus the company has left in order to invest in keep improving the business, in maintaining their brand, their market positioning, making clients want to buy future products. I mean, if you didn't have profits enough to invest in making better phones or cars in the future, then you would be out of business sooner or later. So you would lose that lifeblood of revenues. And also the profit, or actually the cash flow after taxes and investments and other stuff, tying up capital in tools and what have you, that profit, whatever is left over, that is what you actually own as an investor. That is what you have right to, this surplus profit. And it can be given to you in several different ways. You can get part of it in terms of dividends directly distributed to you in terms of cash. But it can also just be kept within the company, for example, as cash, or they might buy other shares or whatever they want to buy with it. Or they can also use it to invest in growing ever quicker, for example, by acquiring other companies or by acquiring more tools and machinery and investing in marketing in order to just grow organically, as it is called. So you could either get the profits they make in terms of dividends right now, or in terms of a higher growth rate and a bigger company in the future. So these are the two absolute most important fundamentals. That is what I talk about when I talk about fundamentals. It's their sales and their earnings. And there are always associated multiples with every fundamental. There are even more multiples than there are fundamentals. But for example, you can pay a certain number of annual profits in order to gain the right of all future profits. So let's say you pay 15 times profits. If profits stay static, it takes 15 years for you to get your money back. And then everything after that is for free. If it's growing quickly, you might get all your money back in just 3 years or 5 years, depending on how quickly it's growing. Another way of valuing the company is using a multiple of sales. That is of the actual, what I'm calling the lifeblood, the raison d'etre of the company. So what the total sales they are creating. A typical sales multiple would be 1 or maybe 2 for the total market. It could be 10 or more for some of the most successful, fast-growing companies. Nvidia, for example, is valued at about 30 times sales. And that is because the market is expecting them to have much higher profit margins and much higher growth than the average company. That's why you can pay such a high sales multiple. But otherwise, the translation between a sales multiple and a price earnings multiple is that, I mean, if you're making 100 in sales and you pay 1 times sales, that is, you pay 100 for the entire company. Let's say they have a profit margin, a net profit margin of 7%. Then they are making 7% times 100, 7. They're making 7 in net profit. Okay, you still paid 100 for this company, right? So 100 over 7, well, that happens to be more or less 15. It's 14 and change. But give or take, let's say it translates to a more or less the same multiple. And for an average company, this is how it typically looks over 100 years of history. You pay 1 time sales or you pay 15 times earnings. And that is the same valuation, given that this is the profit margin and it's the same company, it has the same growth rate, etc., etc. Just again, to emphasize, this is what I mean by fundamentals. It's the true story, the true facts, the true accounting data of the company. What they are selling, how much they are selling for, and what profits that results in. So that's the fundamentals.